Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Good morning. My name is Takeshi. I'm new in the Copeland Theater, the Copeland Lecture Theater. I dropped my USB while I was inserting into this box, the computer box. So I cannot reach that somewhere inside here. Yes. Okay, thank you very much. See you back.
Okay, good morning. Yeah. Okay, I dropped my USB into the box so that I cannot use the clicker or the. So anyway, I can use this. So far we have looked at state capitalism, right, and family capitalism. So this week we are going to look at this so-called informal sectors. Okay, so informal sector is quite prevalent in many parts of Asia, but it's not just Asia, it's actually in many parts of the world. And you might think this is only for maybe emerging markets, but there are, informal financing in, developed markets like Australia. We'll talk about this it's later. But here we'll focus on South Asia. Okay, so especially for the corporate sector, we'll look at India. And we'll see why informal financing is important. Okay. So here, as I said, we'll focus on India, but later we'll talk about so-called microfinancing. So this is not really a corporate finance, but it's more, like personal finance in some sense, or small business financing. But this has developed, actually started in South Asia, so we'll talk about this. This microfinancing actually is not, as I said, it's not just in this area, even Australia has this kind of a financing scheme. Okay. So let's just review about China and India. So as you can see, as we saw this picture or graph earlier, that both China and India has grown over like average of 5%, right, over the past 20 years. And China, it has been growing faster, but India also has been growing, as fast. It's a bit slower, but compared to other countries, this is a very fast growth. Okay, so then how about the size of the GDP? Here we're using this international dollars, right? So it's adjusted for basically price levels. Okay, so here, in terms of, this is 2017, China's GDP in international dollars, right, is number 1. And then US is 2. And actually, number 3 is India. This is the size, right, size of the economy, but adjusting for the price level, or you can say inflation. So in terms of the size of the economy, India is quite large. Okay? But this is what we saw earlier, that this is the GDP per capita, right? GDP per capita. So this is so if you look at that, we remember that both China and India is still way below these developed markets, right? So therefore, where people say that, well, there's a lot of growth potential for these two countries. So this is a review. So GDP per capita, these are from 1 to 30. So you can see, like Qatar is number 1, Macau is number 2. Again, this is in international dollars, right? So this is how it looks like. Okay. So this is just an overview of India. But now, when we talk about law and finance, right, in India, then how does India stand? So India is a former colony of Britain. So therefore, it does have a common law system, right? It's a common law, under the common law system or common law origin. And also the judicial system is British style. So it does have good creditor rights and anti-director rights scores. And but the other thing is it does have a high corruption index. Yeah. Thank you. Yeah, it's somewhere in here, inside. Oh, it's not just me. Okay, I wonder which one. It looks very similar. Yeah. Well, it must be one of them.
Is it just a pointer?
Just a pointer, yeah. So it wasn't just me, yeah. Okay. Yeah, thank you. Yeah, so if it fits here, it must be this.
Is it from the same model?
Oh, both fit.
I think that one's a bit less dusty.
This is dusty.
Less dusty.
It's probably this one. Yeah.
That's right.
Yeah, thank you. Yeah, it's like. Yes, this one. Thank you very much.
Right.
So how come this one, I cannot use this one? This doesn't seem to connect.
No, it's not. It's out of AV. It doesn't go to the computer.
Oh, okay, I see. Okay, thank you very much. Yeah, so this is a summary of this law and finance. So yes, India has good creditor rights and anti-director rights scores, right? So this is British common law origin, but it has a high corruption index, and efficiency and effectiveness of the legal system is below average. But the disclosure score is high, okay, which means the accounting standard is good, but here it says it doesn't mean that the quality of disclosed numbers are good. Right? For example, there could be so-called a lot of earnings management. Right? So even though the firms report these financial statement, the numbers, right, could be massaged or fudged, okay? So that, I mean, earnings management is done in almost, I think we'll say in any country. Any accountants would do this, right? But it's just a matter of degree, okay? But here, in India, it seems like although the disclosure is good, but the numbers can be managed. Okay? Managed is a good word for massaging the numbers. Okay. Okay. So yeah. So this is the actual table that coming from this ACDQQ. Well, this is the Allen, right? Franklin Allen. Remember the China's growth puzzle, right? That was Franklin Allen, Chen, right? Two Chinese authors. And then this one has two authors from India, okay? So that's basically this paper. So I just can click this so you can see the paper. Yeah, so this is financial system capacities of India and China. So basically they're comparing India and China. So this is, Franklin Allen, Rajesh Chakrabarty, and Sankar Du, and Jun Chen. He's at Fudan right now. And also Yu Pen. And then Mei Jun is, our colleague. Yeah. Okay. Let's see. Yeah, so that's this paper. So this compares India and China. And you can see, right, the first column is creditor rights, right? And then both India and China has both score of 2. I have this arrow going up. Up means it's better, okay? It's better if it's higher the number, higher the score, that's better, yeah. So anti-director rights, well, India is much higher than China, right? Because this is under the common law system or the English origin. It's actually higher than the English origin average. And then corruption index is about the same as China, okay? And the panel A, this part, right? English origin, French origin, German, Nordic. These are basically developed markets, and panel B is comparing other emerging markets. Okay? So if you compare with the emerging markets average, which is for creditor rights is 1.69, where China, India is above that, right? But okay, anti-creditor rights is emerging markets average is 3.63, but India is 5, right? It's very high. Corruption is 3.6 for emerging markets, but India, China is slightly lower, right, than the emerging markets average. And legal formalism index, so this is, this score, it's lower the better. The formality, right? Formalism is, I have explained here, right? Formalism ranges from 0 to 7, where higher score means greater formalism, which means that it's slow. The code system is very slow, okay? You can say maybe very bureaucratic, right? So they don't make a decision that quickly. So that's what it means, yeah. So that's why the lower, the better. So China and India is about the same, yeah. And it's better than the emerging markets average. So legality index, right? Legality index is again, it's a score of 5 legality proxies. And yeah, I'm not going into the individual index, a proxy, but this is measure for a good legal system, right? So higher the better. Somehow China, they don't have this paper, doesn't have the number for China. But for India, it's 11.35, which is, slightly higher than the emerging markets average. And this is, the next one is disclosure, right? So disclosure requirement, what they do is they, again, score these things, like prospect, compensation, shareholders, insider ownership, contracts, irregular, and transactions. So, so they look at these 6 dimensions. So they're basically looking at whether these 6 items are disclosed, are required to disclose, right? So that's what they look at. And then India is 0.92, which is actually, quite high, right? Even compared with the developed markets. And emerging markets average is 0.63. So disclosure requirement is quite high. Okay, so that's where it comes, this disclosure seems good in India. But when you look at this earnings management score, which is this, right? It's the average rank across 4 measures of earnings management, and a high score implies more earnings management. So earnings management is when, let's say, let's say you don't want to pay tax this year, right? Well, you want to pay less tax, then you basically change the earnings a bit, right? And of course, you can make it differ, right? You can pay maybe next year, right? Maybe this year the earnings may not be that bad and not be that good. So these are the things that accountants can do. Some are, not illegal. Some are not illegal. But, well, that's important part of the accountant's job, to manage the earnings, right? But in some times, it does hide certain things, right? Which maybe the shareholders may want to know the truth, but accounting numbers may not reflect that, right? So, so it basically, that's why it's not necessarily illegal to do this, yeah. But accountants, in accounting, especially in accounting research, people look at this earnings management as, part of somewhat a negative thing, because it doesn't, if the companies do too much of this earnings management, then it doesn't show the truth, right? Yeah. So it becomes more opaque. The accounting numbers become more opaque. Okay, so that's why they look at this. And then the earnings management score, it's lower the better. So actually India is quite high, 19.1, right? Of course, if you look at these countries like German origin, it's 23, right? It's even higher. Yeah, so these are the these are the law and finance of India. Yeah, unfortunately, this paper doesn't have numbers for China on this legality, disclosure, and earnings management, but at least we can compare India against other countries. So that's why, at least for India, so this is the summary from the table. Okay, so next thing that they do is they do the same thing as what you saw in the paper on China's growth puzzle. So what they do is they compare the size of the capital market, which is the stock market, and the bank banking system. And also they look at both, right, together, how large the, the capital market is. So this is, I'm giving you the summary first. The size and the role of capital market in India has been lower, okay, than developed economies, but higher than average emerging economies. Okay. And the other thing is this: the banking system is very much underutilized. Okay. So I'll show you in a minute. But it says, yeah, the banking system has been efficient compared with other emerging economies. And, and the capital market, right, dominates bank credit. So dominate means that if you compare the banking sector and the stock market, the banking sector is small in India. So that's why compared to the banking market, banking sector, the stock market or the capital market is larger. Okay, so that's what it means. And the development of the financial system, which means both banks and stock market or capital market together, is slightly larger than other emerging economies. Okay, so that is the summary. And yeah, so this is a bit small, but remember this. So this is like bank credit over GDP, okay, in the first column, right? The size of banks in the market, right? So if you look at this red part, it's 0.37 versus China's 1.16. So the size of the bank credit is much larger, right, in China versus India. Yeah, so the average of emerging markets here is 0.65 at the bottom, at the green, the green part, green box. So India is obviously lower, right? At the same time, you can see that China is on the very high side of this bank credit over GDP, right? Other, like Malaysia is high, South Africa is quite high. Okay, and then the second column is non-performing loans. Okay, so it's basically bad loans. So India is 0.07, which is lower than China. China has 0.16. And the value traded, this is a stock market, right? How much the stock is traded in the stock market versus GDP. So this is 0.57 versus in India versus 0.62 in China. Emerging markets average is 0.37, so that's why the size of the stock market, or the money that goes through the stock market, right, is larger. Oh, 0.64, sorry. Okay, no, this is the value traded, so it's a trading, and the market cap, this is the size of the market. In India and China is about the same, yeah. Okay, so the middle part of this table is the structure indices. So this is comparing market and banks, right? So structure activity means it's comparing market minus banks. So it means that this is 0.44 in India versus minus 0.62 in China, means that because this is market minus, right? Market minus banking. So if in China, the banking is much larger. So that's why it's minus 0.62. In India, well, the market is more active than banking. Okay. And the size, right? Comparing the size, yes, the banking, if you compare with China, is the same thing. The market is stock market or capital market is relatively larger than banking, right? So that's how we compare these numbers. 0.56 versus minus 0.59. And this is the efficiency, right? Efficiency is actually, this is market minus banks. So compared to the banks, so the banks seems more efficient in India, right? Because this is market versus the market minus the banks. Okay, so, and then regulatory, okay, structure regulatory, okay, what is this? Okay, it means that sum of 4 categories in the degrees of which commercial banks are allowed to engage in security, firm operation, insurance, and real estate business. So, so this means for each of these fields, like divisions, so security, firm operation, insurance, right? Real estate, are they restricted, permit to conduct through subsidiary, full range of activities not permitted, and 4 is strictly prohibited, right? So 1 is unrestricted, 4 is prohibited. So it's somewhere, you know, they give a score from 1 to 4 in these operations, and then see how it, oops, sorry, yeah. So obviously, in this case, the lower the score, is less regulated. It's more, they have more freedom. So yes, India is less regulated than China, right? It has a score of 10 versus 16. But emerging markets average is 7.97, so it's still higher, right? It's more regulated than other markets. This is the banking. Yeah, this is the banking. This is basically commercial banks. Yeah. Yeah, these, the variable definitions. These are the same as what we saw in the China's growth puzzle paper. So I won't go over this. Okay. And then financial development, right? The last part of this. This is comparing both, right? Market and capital market and the banking. So, so you can see that India is much smaller than China. It's much smaller, right? It's minus 1.56 versus minus 0.33. And the finance size, this is the activity. The size is, again, it's much smaller than China. Efficiency, somehow, efficiency in India is higher. Okay? This is because although the banking sector is small, but it's probably more efficient than China. China, remember, had a huge banking sector, but if you measure using this overhead cost, remember the overhead cost, right? The the measure of this banking's inefficiency is measured with this non-interest expenses, right? So in China, this non-interest expense is high. So that's how they measure this inefficiency. So, in China, that measure was, was low. So I think that's why in India has higher efficiency overall. Okay. Yeah. So that's basically the comparison between India and China. Okay. So let me see. Any questions on this table? Is it all right? Yeah. Okay. So this is by looking at this domestic credit provided by banking sector. Okay. I wonder why this is only up to this 2009. Okay. But anyway, this is as percentage of GDP. You can see that this brown line is the highest, right? This is actually Japan. This is comparing credit provided by the banking sector over, GDP. So it's about, 350%, right? So it's like, like 4 times, right, greater than GDP. So that's why I think I have mentioned earlier that Japan and Germany, right, is relatively is more rely on bank financing than capital market. Okay, so that also shows in this. Let me see. Actually, yeah, this is USA. The purple, right, is USA, and this blue one is Germany. Yeah, the EU. Yeah. So, so that's what I mean by bank, especially Japan is quite bank dependent. And then comes USA, and this China is the red one, and the green one is Korea, and you see this last two, right? India is this orange, and the Bangladesh is the yellow one. So you can see these two South Asian countries has much lower dependence, right, on bank financing. So this, is what this is, consistent with what this paper's result. Okay. Size of the banking sector is small. So in other words, the banking sector is underdeveloped or underutilized. Okay. Okay, so so if the stock market is small, right, and then the banking market is banking sector is underutilized, then how do firms finance their investment? Okay, so so first, if you learn from corporate finance, basically, if a firm wants to finance their investment, well, if you remember the pecking order theory, first they rely on internal finance, right? And then next on borrowing, right? Debt, right? And then finally they rely on equity, right? So that's the pecking order theory. But if the capital market or the external market is not developed, they probably have to rely much on internal financing. So that's what we see here, right? So this is looking at the sources, right? Financing patterns for Indian firms. And you can see that this is internal sources, right? The green box is for all firms. Is 45%. LE is large firms. SME is small, medium, right? Enterprise. Small, medium enterprise, actually internal source is less, but you look at others, right? Large firms, they rely a lot on internal sources. Okay. And of the large firms, they look at listed versus unlisted, right? So even though the listed firms, listed means that they can, issue equity, right? They can issue equity and finance through the equity market, but yet you can see that even large listed firms, 58% is internal, right? So they don't rely much, right? That's why the stock market, is small. but it's not clear whether because the firms don't use the stock market, that's why stock market is small, or stock market is small, so that's why firms don't raise capital in the equity market. It's not clear why, but the fact is listed, right? Large firms even use internal sources. Small and medium enterprises, sort of similar, right? But again, listed ones use internal, right? Okay, now market finance this is where they use the capital market, right? It's either stock market or bond market, but I believe bond market is not very large. Yeah. So you can see the proportion, right? So actually small listed SME, right? Listed SMEs actually use more market financing. The large ones, they actually don't. Yeah. Bank finance, yes, they do to some extent, but it's about, like altogether, total average is like 18%, right? And unlisted firms tend to use, because they cannot issue equity, so that's why they rely more on banks, right? So that is true compared to listed ones, right? Listed ones, non-listed ones rely more on banks. Okay. So another large item is this so-called alternative finance, right? So this is again, right, especially for large firms, like 21% is coming from alternative financing. Overall, it's like 30% of the firms rely on alternative financing, especially for small and medium-sized enterprise, like more than half, right, comes from alternative finance. So it looks like in India, large firms rely more on internal financing, right? And the small firms rely quite a lot, especially those unlisted ones, rely on this alternative finance, okay? So, so what is this alternative finance, right? Yeah, so alternative finance is, external financing, but it's not necessarily coming from the market, right? Like a stock market or bond market. It's raised from private sources, okay? So including group companies, promoters and founders, trade credits, and other liabilities. Yeah. So it is external financing, but it's not coming from those, formal equity market or debt market, or even, like banking, right? It's not banking. So that's where, what it means by informal. Okay. So what does this mean? Okay. Now, okay, look at this later. Yeah. So let's look at the ownership structure. Okay. I have circled here, right? This is yellow. Last column is circled family and individuals, right? So looking at the controlling shareholders, you can see that the family, right, individuals are quite large, okay? So, okay, sorry, yeah, India is right here, yellow one, right? So this is 78%, right? 76%. Full sample is 78.3%. If you compare with China, where China does have, family or individual ownership, but it's like 20%, right? And we know that in China, the state ownership is much higher. India doesn't have much. So, and this is comparing with this, LLS sample this is a paper that we saw earlier, right? Compared to the LLS sample, this is large firms. Panel B is medium firms. Of course, medium firms, smaller firms have higher family ownership or family or individual ownership, but India is much higher, right? So this shows that India does have a concentration of ownership in the family. Okay. So the summary is that Indian firms largely rely on alternative financing, right? Also internal, right? And it's outside the formal. It could be right, expected to be outside the formal legal system, right? And also the corruption index was pretty high, so that's why for these Indian firms it might be, cheaper, or you can reduce this so-called political cost or other risk, right? If you use alternative financing, which means that you are borrowing, right, from maybe your family members, okay, or borrowing from group companies, right? So I will show you that in a minute. Because again, the banking is small, right? So you cannot rely too much on banking. It's very underutilized, which we don't know why. Why it's underutilized. Maybe there's corruption, or the banking system doesn't just work well like other countries. It's probably, well, when we talk about microfinancing, you can probably figure out that not many people have bank deposits, okay? So you cannot borrow from banks. So if you live in places like Australia, then everyone has bank deposit, right? And then the banks will chase you after to borrow money, right? Ask you to borrow money. So it's not like that, right? First of all, people don't have bank deposits. So there's not too much money in the banking system. So that's why the banking system is small. Yeah. So, so that's why firms as well as individuals has to rely on this so-called informal financial system. Okay. So, so this is a paper by, it's hard to read this one. I won't read this. Yeah, this one's easy. Radha Krishnan, okay, thank you. Radha Krishnan, Gopalana, Vikram Nandab, Amit Seruk. So they look at this affiliated firms and financial support, evidence from Indian business groups, okay? So, so this is, this shows, they study how the Indian business group behave, and they look at, they find the fact that yes, they do use intra-group flows, which means within a business group, they finance each other. So that is 59% of operating profits, right? So, so basically it's like an inter-group loans, right? And says the loans are the dominant observable channel through which Indian groups transfer cash across member firms. So they are basically lending money to each other or financing each other. And evidence indicates the group extend loans to more troubled firms or weaker firms. Yeah. So we'll see similar things later next week when we talk about business groups in Korea. Okay, so it's a similar pattern of behavior of group firms. Okay. Yeah, so that's what they find. So that's why their findings is quite consistent with the financing pattern or patterns of Indian firms. So these are basically informal loans, right? It doesn't come through the banking system. It doesn't go to the external formal capital market. It's within the business groups. Okay, and so what are the Indian business groups? You might have heard of some of these, right? Which one do you know? Yeah, Tata. It's very famous, right? Yeah. Like Wipro, yeah, you might have heard of. Yeah. So these are the pretty, the big ones. Yeah. And what was the Tata? Yeah, Reliance. Yeah, I think. Yeah, like some of them. I think it was Tata bought like British automobile companies, right? Like Jaguar, Land Rover. I think that's under Tata right now. Yeah. So, yeah. So these are the major Indian business groups. So many of them are family. It's basically a family firm. Okay. So, yeah, so what is unique about the financing patterns of Indian firms? Yeah, what is the reason? Well, I guess these are the questions, summary questions, yeah. So what are the differences between Indian firms and Chinese firms? Both, government structure or also the financing structure. But these are the questions that you might see in the exam, yeah. So, okay. So let me see how I'm going. Oh. Okay. So any questions up to here? Okay. Okay. So I'm not sure if I can finish, but I'll go, talk a little bit about this microfinancing. Okay, so this is another form of informal sector, but today, first we talked about corporations, right? But in places like India, or especially like Bangladesh, the banking system is not well developed. So as I said, not many people have deposits, right? And if you don't have deposits, you cannot borrow money. So how do you finance, right? So that is the biggest problem, especially for small, like individuals, right? If individuals want to do business, then how do you start your business? Of course, if you have savings, then you can use your own savings, but probably not. Those people are, limited in numbers. So that's why this informal sector financing becomes very important, and it has developed. So how did it start, right? How did it start? It's interesting. It started with this professor called Muhammad Yunus, okay? And he won a Nobel Prize. But it's not Nobel Economics Prize, it's Peace Prize, Okay? So, and he created this bank called Grameen Bank, and this is the model that, you know, has started to be used, okay, in different parts of the world. But actually, this kind of loan or financing, actually similar things has been, you know, used informally, like in many countries in old days. Okay? So this is what they call the banker to the poor. And then he established this Grameen Bank in 1983. This is from Bangladesh. And what he says, well, credit is a fundamental human right, right? So if you could, you know, starve if you cannot have credit, right? So it's a basic human right. So his objective was obviously to help the poor people get out of poverty. But then for poor people, the banks won't, right, lend money, right? Especially when, like places like Bangladesh, the bank is not that developed. They don't lend to these poor people, small, you know, individuals. So, so how to, you know, get loans to these people? Well, this Dr. Yunus, first he used his own money. Okay, he personally loaned his money, right, to the basket weavers in Bangladesh, yeah, in the mid-70s. So that, I think that's how it started. And, and then he has established this system. So I will show you how it works. Yeah. And basically, this model became pretty standard in, you know, like it says 100 countries worldwide. So you can click this. Yeah, so this is, you know, yeah, so this is, you know, this is the website of the, let me see, yeah, Nobel Prize. So here is, you know, Mohamed Yunus, and then, yeah, so there's his biography, right? So here it is. And then, yeah, so that's him. Yeah, so that's just. So, yeah. So the thing is, as I said, most people in poor countries don't have, I mean, cannot access banking, right? So in like India, like 40% of the population does not have bank accounts, okay? And like, you know, over 75% of Indian population still lives below $2 a day. So that's very poor. So, so then how do these poor people get the financing? Okay, so here comes this economics, right? So in this kind of situation or this kind of economy, okay, what do you think? Okay. If you know, if you have learned microeconomics, you probably have heard of this, you know, principle of diminishing marginal returns to capital, right? So what does that mean? Well, it means that when you start a firm, then at the beginning stage, the return is high, right? So that you have, are you cold? It is cold, right? And it's very cold here. Yeah. No, this is not. Yeah. Excuse me, I wear this. so if you learn microeconomics, then like at the beginning, when the firm starts, then if you invest maybe let's say $1,000 in the firm, then that can generate maybe 20% at the beginning, right? But as the firm becomes larger and larger, then for every $1,000 of investment, incremental investment, right? Then the return becomes less, right? So that's basically the principle of diminishing marginal returns to capital. So this is basically of the extra investment, right? Same $1,000, but when the firm is smaller, that $1,000 can generate more higher return. So then if you think of like small business, right? Then you can think of smaller enterprise could be having a higher return. So that's why if the return is higher for smaller firm, then these enterprises should be willing to pay higher interest rates, okay, than richer enterprises. So that simply because the return on the firm, right, is higher, okay. But then, in that case, someone, right, from someone, you can say it's rich depositors, right, can lend the money to the poor entrepreneurs, okay? So the money should be coming from somewhere if the return is high, right? Yeah. But the thing is, traditional banking doesn't work in these poor countries because even though their return rate might be high, the poor borrowers don't have so-called collateral, right? So when the bank lends money, they always want collateral. So in case the borrower cannot pay back, then they can, seize that collateral, right? So it's like if you borrow money from a bank to buy a house, then basically it's a mortgage, right? Then the house becomes a collateral, right? So if you cannot pay back the loan to the bank, then the bank can take the house. So that's the collateral. So that's why banks are happy, right, to lend money to you because you have the collateral. But for poor people, they don't have the collateral, right? And also, they don't have information of like individual borrowers, right? If you go to a bank like in Australia, then when you open an account, then you put your name, address. Sometimes they ask about you, like your income and all these things. So therefore, they know more about you, right? And you have more information to provide if you have a job. But for like poor farmers, they don't have this kind of information, right? And also, since the amount that these small enterprise can borrow is small, right? It's a small amount, but many of them, right? So in that sense, it's too costly for the bank to basically to look at every one of them, right? So it's just too costly. So that's why the banks don't want to lend money to these people. Okay, so basically there is greater degree of information asymmetry, right? And so-called adverse selection and moral hazard. So this is the concept, economic concept you might have heard of in especially in banking. Okay? So adverse selection is when banks, right, cannot determine which customers are likely to be riskier because of this information. They don't have enough information, right? And well, of course, there are, credit-worthy customers and not non-credit-worthy, right? Less credit-worthy customers. So if the banks know the customers, then the banks can charge higher rates for those who might default, right? The risk of default is higher, right? And then offer lower rates for more credit-worthy customers. But they don't know the information. That's the problem, right? So what they do is the banks will offer a same rate, right? Then in that case, it will be higher, right, for safe customers, right? So the safe customer will say, how come I have to pay this high rates? I'm a safe customer, right? So therefore, what happens is that since these safe customers don't want to pay higher interest, they won't borrow from the banks. Okay, so that's adverse selection. So this concept is similar in insurance. Insurance, you can just replace this with, let's say, if it's a life insurance, it's health, right? So although the insurance company will, before you buy insurance, they will ask you questions about your health and all these things. So they will know more and more, right? They want to know more and more, but they probably cannot know the truth, right? There is limit to what the insurance company can find about your health, okay? So therefore, the insurance company will typically, based on that examination, they will decide on the premium. But still, what happens is that they cannot find, right? So if they don't do a good examination, then that what happens, or they cannot, find how healthy their customers are, then they will, right? The insurance company can charge rates which are higher, right, for healthy customers, right? So then the healthy customers will say, why do I have to pay this premium, high premium, so they'll go away. So then, in the end, the insurance company will end up with unhealthy customers, right? That's adverse selection. So this is the same thing, but the information asymmetry, that drives this thing, right? So moral hazard is a case where, the banks are unable to ensure that customers are making the best use of the money, okay? Which means that in the worst case, the customers can run away with the money, right? They borrow from the bank and they run away, right? Yeah, so especially, so this is called moral hazard. And if the problems are worse, if the judicial system is worse, right? So they can easily run away, right? So that's why, because of these, asymmetric information, adverse selection, and moral hazard, that's why the traditional banks, it's difficult for traditional banks to provide loans to poor people, especially poor individuals. If they have collateral, right? Then they're not poor, right? If they have collateral, then banks can lend money, and then in that case, they can seize the collateral. But so that is the problem. But so-called money lenders, or you can say loan sharks, right? They have information, right? They'll probably knock on each one's borrower's door, and they will know each one, right? And then If they cannot pay, they will threaten you, right? These are the loan sharks. But the thing is, they don't have the resources, right? They don't have deposits. These are not banks, right? It's not clear where this money is coming from. So money lenders, yes, they do have information, but they don't have the resources. So that's why the traditional banking system doesn't work. Okay. Okay. So how does this Grameen Bank work? Well, this is they say it's an innovation by Grameen, but as I said, there has been similar systems in different places. But what they do, the key part is this, right? The mechanism that allows the poor borrowers to act as guarantors of each other, okay? So they don't have the collateral, so they have to make sure that the borrower will pay back the money, right? But the thing is, as a group, they make sure someone who borrowed pays back the money. So it's like a peer pressure, okay? In a standard bank loan relationship, the borrower, right, gives the bank the collateral, right, as security, right? If borrowers cannot repay, the collateral is seized. But Grameen clients don't have this collateral. So that's why this loan contract involves a group of customers, okay? So the group is formed voluntarily. So you form with with your people, those who you know. And while loans are made to individuals within groups, all members are expected to support the others when difficulties arise. Okay, so that's why it's like a peer pressure kind of thing, right? So if you have a group, but you can form the group, with people that you like, right? And then you make sure that whoever borrows can pay back, right? So that's why these members act as guarantors of each other. Okay. So that's basically called joint liability. Okay, let me see. Yeah, so there will be a bit more, detail. Okay, maybe I just, yes. Okay, I'll stop here. Yeah. Okay, any questions? Any question about the project? All right? It is quite cold. Yeah. So, yeah. Okay. If not, then I see you on on Thursday.
Yeah. Right. Yeah.
Our group going to choose 3 countries like mainland China,
Yeah.
Hong Kong, and Japan. If that works.
They have to pick a firm, not the country.
Oh, I know. I just picked a few from those 3 countries.
Yeah, that's all right. Yeah,
That's all right.
that's okay. Yeah. Yeah.
So that is part of it, but but what you need, even in, of course, that's you have to consider that. But more important thing is the firm, right? Especially when you have to look at the ownership structure, right? So that's the key.
Can you give me some sample about the? Oh, you mean if we find is? Can I ask you some question about the disadvantages of the family group?
Yeah.
That is the
So
disadvantage.
one of them could be, if there's if there's like a high concentration, right, of one family,
It
so-
will be harmful for other stockholder.
Yeah. So those are the things.
Can we use some graph from your lecture?
No, you're supposed to look at individual firm, right?
Yes.
Yeah. So that's why you have to find the firm and then present those information in the report.
Oh,
Yeah.
okay.
You're not supposed. Don't use my.
Okay.
You need a unique guide that the farmer is due on the what is the investigation? First, they go over the price.
20. I think it's 20.
The unit guide just say the delay.
Unit guide.
Yeah, just make delay.
Giving that. In your meeting.
Okay.
I thought there was a date of assessment deadline on the internet. Because I have a copy. Yeah.
But I think it's last year, because in the Chinese year is that May 20th, but it's 2008. So that's why.
Is it?
Yeah.
Okay. Then I have to go.
Okay.
Yeah.
A bit more about our figure. We changed the idea of our load time.
Yeah.
I was wondering just that maybe something like countrywide or the low. So we use this standard to check the front. So we set the standard and then we choose from the needed standard. So we will count it to run and another from the do not meet the standard and we can so just maybe three this kind of standard like countrywide ownership.
Yeah.
It's fine just to write the three standard and then choose one and then make a six stop.
That is, if you can, if you choose three standards and then, you can do that too, But the thing is, problem is, some of the firms, for some firms, the information might be lacking. Right? So that's why you cannot say, okay, let's say you have these three standards, and then if you go through each firm, you may know, for some of the standards, maybe you cannot find information, right? So that's why you may have to look a bit more on some, for this kind of case, you look at some other information for the firm, right? So that's why you have to look into the financial report or, look through the web, right? And then find what's behind this.
So we consider all
It's
kind
not,
of
it's not, you cannot do this mechanically. It's a very qualitative information. So that's why, it is like a financial ratio, it's easy, right?
Yeah.
But in this case,